Now, we will start with the main operating activities of cash flow statement. There are four steps involved. Okay, first one is we find out profit after tax. Actually, this has to be calculated in working note. But here, first we are trying to understand. Whatever doesn't come in investing and financing comes in operating. Operating means principal revenue generating activities, main business for which you are working. But the problem is no one directly tells you their sales and purchases. So we have to use the indirect method. When I use the indirect method, I have to go in the reverse sequence. So we have classified it into four steps. Step 1 is after calculating profit before tax. Sorry, we are given profit after tax in the question. We are given statement of P&L, which is given to us under reserves and surplus, which is given to us under shareholders fund. So this statement of P&L, two amounts are given: current year, previous year. So we take this statement of P&L as current year minus previous year. We find out that amount, and that is your profit after tax. It may be negative also, you will put it in bracket in that case. And then we add to it four things. The mnemonic which we are using is dirt for that, where D stands for the dividend paid. Dividend we have seen is given in additional information, and there we used to need to use the previous year amount. I stands for interim dividend, which is given in the additional information again. R stands for reserve. Any increase in reserve is added, general reserve, etc., or decrease is deducted. And then we take here provision for tax made. Provision for tax is again given to us generally in notes to account. It's a part of short term provision, which is a part of current liabilities. Under that, we have two amounts: current year, previous year, provided it is given in the balance sheet or notes. So there are two amounts: one is current year amount, one is previous year amount. When there is no additional information, we follow the rule: previous year paid, current year made. That means previous year amount is paid by us and current year amount is made by us. Here we are expected to add the current year amount. Sometimes they give you additional information also. That additional information can be about paid or made. So we will prepare provision for tax account. It's a liability brought down, previous year amount comes here, carried down, current year amount comes here. We follow the rule PM. The amount paid by us as taxes comes here, and amount made as provision comes here. One of the two could be given to us, the other will be balancing figure. Both are used in operating activity, so you have to carefully find out. If nothing is given, previous year paid, current year made. So after adding this dirt, what we get in working note 1, this will be a part of our working note 1, is profit before tax. Now we use this amount of profit before tax, which is profit after tax plus dirt. We add to this basically wild. Other things are also there, main are wild. W stands for writing off of goodwill, patent, trademark. That means decrease in this. I stands for interest on debenture, loan, etc. L stands for loss on sale of fixed asset or investment. When we were doing investing activities, we were saying that we may sell asset or liability at profit or loss. Loss is added, and obviously profit should be deducted. D stands for depreciation. Any depreciation which we have on any fixed asset during the year. There were two depreciation. One which was for finding out profit loss on assets sold, that was. We are not talking of that. You are talking on all assets which we are having depreciation in that. When we prepared accumulated depreciation account, the one given on credit side statement of P&L, this is depreciation during the year on all assets that we have. This needs to be added. Any interest, rent, dividend, etc. received by us or profit on sale is deducted. This will give us operating profit before working capital changes. To this, we have to adjust for working capital is what? Current asset and current liabilities. For these, the increase decrease in these is taken into consideration. The amount of, I repeat, the amount of increase decrease. And the rule followed is current asset is not having good relations with cash flow. Decrease is added, increase is deducted. Current liability has a direct relation. Increase added, decrease deducted. So what we add? Increase in current liability. Current asset has reverse relation, so decrease in current asset. What we decrease? Decrease in current liability, increase in current asset. We get operating profit after working capital changes. This was before, this is after. From this, when you pay taxes, you get cash flow from operating activities. This may be positive, this may be negative, and this tax paid we have got from provision for tax account. If we are not preparing account, then previous year amount will be taken for provision for tax. Let's quickly look at one example based on this. One minute. Here you are given statement of P&L. Let's look at a better version of this. Let me add a page to this. This is the example. You are given, this is extract of balance sheet. In that you are given surplus statement of P&L. This is your profit after tax. General reserve, this is a part of DIRT's R. Goodwill is decreasing. So this is a part of wild writing off. Machine is decreasing. We will see the adjustment if account required. Furniture, asset account. Debenture is required from the point of view of interest. That wild I is interest that we will get from here. Trade receivable, current asset. It is decreasing. Decreases in current asset are added. Current liability is increasing. So there also current liability increases has direct relation. It will be added. Let's see the other things which we have. We have depreciation during the year on machine rupees 30,000. Let me prepare a machine account here. No other information for machine. We have a brought down of 4 lakh 30,000. We have a carried down of 4 lakh. Previous year, current year, brought down, carried down. We are told that there is depreciation of 30,000. That's the cause of decrease. So there's no purchase, no sale in this question. But this depreciation during the year will be added under wild. This is D of wild. During the year, this furniture costing 30. on which accumulated depreciation was 20. 30 minus 20, 10,000. Sold at a loss of 5. And depreciation on machine on furniture is 40,000. So we have more information for furniture account. Let's prepare it. The brought down for that, which is your previous year amount, is 1,30,000. We have carried down amount, which is 2 lakh, which is current year amount. We have charged depreciation. So statement of P&L, this is depreciation on all assets which we are having, 40,000. Let's come to this profit loss. 20, 30 minus 20, 10,000. Sold at loss of 5. So loss comes on credit side, 5,000. This loss is the L of wild. This will be added as wild L. And bank, we are making a sale at 5,000 rupees. And when we will, if we have been asked investing activity, we will get bank balancing figure, which will be the amount of purchase. So let's see the amount here. This is 2,50,000 minus 1,30,000 is the amount of purchase. 2,50,000 minus 1, 150. 150 minus 30 is 120 is amount of purchase if asked. Debentures were issued on first day itself. So throughout the year, we had debentures of 2 lakh. Interest will be 2 lakh into 5%, which will be 10,000 rupees. 2 lakh 10% is 20, half of that is 10,000. And interim dividend paid is given. That is a part of our dirt in case of operating activity. Tax paid is given. There is no provision for tax given here. Provision for tax is missing here. So whatever is paid is considered to be made also. Double treatment. Tax paid will also be this, provision made is also this. We provided this amount, we paid this amount, so there was no need to give extra information. Now we will use the information from here in these 4 steps. First of all, in working note, we do step 1. We have profit after tax, which I showed you here. Let's get back to the question. 4 becomes 7. So this amount for me is profit after tax is given. This amount for me stands out to be somewhere rupees 3 lakh. Now next step which we are given is interim dividend paid. We have paid interim dividend, dirt, reserve, provision for tax paid and made is same. So we get profit before tax of 4 lakh 14,000. Now to this we add wild. In wild I have goodwill decrease of 1 lakh, loss of 5,000, interest on debenture which we calculated 10,000, and D is depreciation both on machine and furniture, which was 70,000. I get operating profit before working capital changes as 5 lakh 99,000. Now we will add to this the decrease in trade receivables. Sorry, there is a change in trade payable and receivable. We will be adjusting for that, and then we get 5 lakh 94,000 as operating profit before working capital changes. These are current asset and current liability changes. Both will be added, and then we will deduct the tax paid by us. We get cash flow from operating activities. This is our cash flow from operating activities. That's cash flow from operating activities. Thank you.